belt in his 10 plus years of education in personal finance. Welcome our community outreach coordinator, Felipe Arevalo.
Hello, Chase. Thanks for having me. Look forward
Yeah,
to
we're
the
very excited.
presentation.
So I will have a couple of housekeeping things and notes before we get started. We will have plenty of time to answer questions after the presentation. The presentation will be about 20 minutes long, so that'll leave us anywhere from 10 to 15 minutes for all your questions, and we will do our best to get to all of them. As you can see, what we would like if you can do is in the chat, if you have a question, you can write that out just like you can see in the chat box. And in this case, it's just how do I boost my credit score? Very, very simple question. And if you do that, then we will then get to those questions, the order that they came in. And if there's multiple questions, we'll try to answer those as well. All right. You will notice also that the questions go directly to the hosts. So we will can stay away from having active chats on the side. So after further ado, Felipe, take it away, bud.
All right. Thank you, everybody, for joining us for our pilot, our first Smart With Your Money Live. Today, we're going to start with the very important, very popular topic, how to boost your credit score. And yeah, we'll get right to it. Don't want to take up anybody's time. So today, we're going to go over what is a credit score? How many credit scores do you have? Because believe it or not, you have more than a few. What are the factors to a FICO score? And how to improve your credit score in 4 easy steps. So if you stick around, you'll definitely hopefully learn something new and get some tips that will help you along your financial journey. First of all, credit score variations. When it comes to FICO, and FICO is the Fair Isaacs Corporation, abbreviated down to FICO because we all like shorter names. But according to myfico.com, consumers have over 29 different credit scores. And then you take into account the fact that we have 3 different credit reports. You can see how it really adds up to the different variations of scores that you can have at any given point in time. Currently, the most widely used FICO variation is the FICO 8. It's not the newest FICO score, but it is still the most widely used. When FICO puts out new credit scores, it then becomes the choice of the lenders to whether they want to switch or if they don't want to switch. And sometimes that switch can be an expensive conversion. You got to change a lot of things. So it's not always here's a new credit score and everybody is using it. The first version of the FICO score was created in 1989. It's been around for a little bit. And it's definitely gained popularity since then. The FICO score models they're updated. They change because we know lending changes and trends change. So they adapt them to the different ways of borrowing and lending that take place throughout time. Just to keep them as relevant as possible. Within FICO, they have traditional and industry-specific scores, and that's how they come up with so many different credit scores. Is you have your traditional kind of encompassing everything score like a FICO 8, and then you have other ones that are specific to any given industry or different industries where lending is a common practice. For example, you may have an auto lending, FICO auto score, one specifically for credit cards, and another one that may be specific to mortgages. And this just allows the lender to gauge the level of risk that any individual has, more hyper-focused on their industry. So you're asking for an auto loan, they can gauge with a little bit more accuracy what the different, how likely you are to make or not make your car payments. When it comes to credit scores, and this is something that's very important to remember when comparing credit scores. You may get a free credit score from a website, maybe your credit card company, maybe you're out trying to make a credit card or a vehicle purchase, there's different um, there's different scores. So you have to make sure if you're comparing one credit score to the other that you're comparing apples to apples. So just because you got a free credit score on a website or from your credit card company, and then you go get another one at the car dealership when you're trying to buy a car, it may be a difference in the score. It could be even a significant difference. It doesn't necessarily mean that your credit has changed drastically in the time it took you to drive from home to the car dealership. It just may mean that you're not looking at the same credit scores. The most popular non-FICO credit score is going to be the Vantage score. And it was created as a team effort between the 3 credit reporting bureaus. It was first introduced in 2006. So that itself has been around for a while. But compared to FICO, it was a little late into the game, and FICO is still the predominant credit score and the one that's used in over 90% of credit decisions. So, it's important to understand that there are other scores out there, but the FICO is still kind of the one you want to concentrate on the most. Also, some larger lenders may develop their own custom scoring models in which they will incorporate your FICO score, your Vantage score, and add a few more variables that they deem important to try and come up with a new customized score. So whenever you get a credit score, you're looking at your credit score, be sure to try and look and see what credit score you're looking at, and if possible, also what credit report that information came from. So that later down the road, if you compare it or you compare it to a different credit score that you got elsewhere, you can kind of gauge whether you're looking at the same score or not. And it's very important so that you don't, panic and you say, wow, my credit score dropped or increased drastically in the last 5 minutes. And all I did is log into a different credit card website. All right. So you have your average credit score by age. And the reason I wanted to include this slide is, and it's an average. So if you're not at the average for your age group, that's okay. You can still get to whatever credit score you want to get to. But as you see, typically as people get older, their credit score increases with time. Now, so many different factors that go along with that. From learning to use credit more responsibly to having a longer credit history. Being able to start paying off certain things, whether it be early credit card debt that someone may have gotten themselves into, paying down cars, paying down student loans, paying down mortgages. But as you progress, your credit score, the average credit score goes up. So you can kind of see where you fall within your age bracket, and then work your way from there to try and. This is especially useful for the really young. If we have any really young listeners right now, sometimes when we talk to college students, they get a little discouraged, but with time you can get your credit score to be where you need it to be or where you would like it to be. All right, so what are the different factors to a FICO score? And this is important. This is one of the most important slides that we have here in this presentation and pretty much all of our credit presentations as a whole. And the 5 different factors that go into a FICO score. We don't know the formula. The formula is going to be, but we know what goes into it. And the first most important thing is going to be 35% of your FICO score is your payment history. And that's why it's very important to always make your payments on time. And that's why it's very important to, when you can, not miss payments, pay attention to your credit, and get into the habit of making that monthly payment. Next, you have your debt to credit ratio. That's 30% of your credit score. So, and this one's a little bit more confusing. The payment history is pretty straightforward. Make your payments on time every month. Your debt to credit ratio is the amount of money that you owe compared to the amount of money you have available to spend, your credit limit. And you want to keep that below 30% usage. Uh, Once you start going over that 30% usage, you'll start to see the negative effects on your score. If you want to be real high achiever, keep it below 10% or at zero, somewhere in the single digits. Use your credit every month and then pay it off every month to keep that debt to credit ratio down. Um, if you have credit card debt, it's okay, because as you make payments, and this is why it's important to pay down your credit card debt. As you start to make payments, your debt to credit ratio starts to decrease, and therefore, your credit score, your FICO credit score, will start to move in the direction that we all want our credit scores moving. The next biggest factor, and this one's hard if you're new to credit, if you're just getting started with credit again, is your length of credit history. How long have you been using credit? How, do you have that history for lenders to look into? If you just started using your credit card for the first time, or any type of credit for the first time 2 months ago, there's not much for them, not much data in there as far as payment history, as far as your usage, for them to judge, how, or make an accurate guess on how you're going to work with credit. It's just not there. If you have, a long payment history, now there's more ability to predict which way you're going to do. Are you going to borrow a lot? Are you going to make your payments on time? So that, it just takes time to build. And we talk to people all the time and say, how can I improve my credit real fast? Unfortunately, improving your credit real fast is a tough thing. It doesn't really happen unless you have some really, unless you have a lot of errors on your credit, which will be an upcoming presentation here. Your credit score can go down very quickly. It's a very slow, steady climb. So, and that comes partly because of the length of credit history. And then you have your types of credit. You want to have a mix of credit between your revolving debt, that would be your credit cards, and your installment loans, your car payments, your student loans, your mortgage, where it's a monthly installment, same payment every month, compared to your credit cards, where you have the ability to go incur more debt, and you also have the ability to pay down more debt. You could pay it off in full. You can not use it this month. You can go on a shopping spree next month. So it allows them to show, it allows them to predict, your habits, and you want to have a good mix between the two types of credit. And then lastly, the 10% is your credit inquiries. And this is going to be times hard inquiries. So there's two types of inquiries, and it's important to make the distinction between the two. You can pull your credit as many times as you want yourself, and it won't hurt your credit. Right now, due to COVID, and you can actually check your credit report once a week, and it's maybe a little excessive to do it weekly, but it's a good practice. Usually it's once a year for each of the three credit reports. But if you wanted to, you could check it over and over and over, and it won't hurt your credit. Those are considered soft inquiries. So, if you pull your own credit, if you go and you have DebtWave pull your credit, those are soft inquiries. Your bank or credit union may be pulling your credit to offer you your free score when you log into your online banking. Those are going to be soft inquiries. They will show up on your credit report, but they don't get calculated into your credit score. The ones that get calculated into your credit score are going to be hard inquiries. When you authorize someone to pull your credit with the purpose of acquiring new or more credit, that's going to be a hard inquiry. So if you're at the car dealership and they say, let's run your credit, let's see what kind of numbers we can do, let's see what kind of payments we can get you, those are going to be hard inquiries. You sign it, they go back, they pull your credit. Now, if you go out car shopping this weekend and you go to 3 or 4 different car dealerships because you're trying to find the right car, you're trying to get the best deal for yourself, it's not going to go in as 3 or 4 different hard inquiries. They're all going to get grouped into one event. So it's not going to be the most devastating thing in your credit. Credit inquiries, yeah, they can hurt your credit, but it's not going to be a huge negative impact where you can say, oh, wow, my score is just gone because I pulled my credit this weekend. So, and then just don't go to the mall, for Black Friday and, start trying to make your credit report look like a mall directory, because that will have a negative effect on your credit score. So now we've kind of gone over the different types of credit, the fact that there are different credits, and we've gone over the different factors to the FICO score. But the important question, the question everyone's here for is, what do I need to do to have better credit? How can I boost my credit? Because that's kind of the question. That's the goal for most of us, is to increase our credit score as much as possible. And here you go. 4 easy steps. Anyone could do it. It doesn't matter who you are. It doesn't matter, your credit history up until this point. It'll just mean a different starting point. It doesn't matter who you are. 4 things you can do to better your credit score, to make sure that down the road, when you need your credit score, it is where you want it to be. And here they are. Step number 1, never miss a payment. Make your payments on time. You don't want to get into the habit of making just the minimum payment. That can get very expensive. You end up paying a lot of finance charges. But if that's all you can afford, at least make the minimum payment. If that's all you can afford this month, or talk to your lender and see if there's special programs out there, but don't miss a payment. Now, if your payment was due yesterday, but you had a very busy day, kids started school, Zoom and Google were down, and you just totally forgot to schedule the payment, you've actually haven't been reported to the credit bureau yet. You may have incurred the fees, your APR may go up. So there are a lot of negatives that could happen, but you haven't ruined your credit yet. Your late payment with the creditors isn't going to be reported until you go 30 days past due. And that's why it's important to just always make those payments. But if you go 30 days past due, you're going to start to see possibly a very significant decline in your credit score just by going one credit card one time 30 days past due. You could see a significant dip there in your score. Step 2, pay down your debt. And I know a lot of you watching this right now are on the debt management program here at DebtWave. And this is where this will be a big benefit, because you are paying down your debt and you want to pay down your debt as fast as possible. That will allow you to take care of that debt to credit ratio that I mentioned earlier. And if you have less money going towards your interest, you have more money going towards your principal. That's going to get you out of debt faster, and that's going to help get your credit score going in the right direction a lot faster. So you make your monthly payments on the debt management plan, and that decreases your debt faster. And now you see the increase in credit score a lot more rapidly. Step 3 is get the healthy mix of credit. That kind of comes naturally. You don't want to rush into that. You don't want to go get a car loan just because you want to have an installment loan. That'll just kind of come with time, and you may have your student loans that you're paying back. You may have your car loan or a personal loan that you're paying back eventually, maybe you already do. You have a mortgage. That comes naturally, but you do those things and apply for credit sparingly. You're going to get a new credit card, do your research first, and by that, I don't mean go applying for 5 different credit cards to see which one's the best one you can get. Is try and figure out which one best suits your needs and you might get approved for as well. And then go into applying just to that one credit card. Just because they're offering you an extra 5% off on a t-shirt or your purchase today doesn't necessarily mean that's the best card for you. Just because you've been pre-approved doesn't mean that's the best card for you at this point in time. So apply for credit only when you need it. Now, DebtWave clients, I know I'm out of time here. I am just about done. If you're interested in a free credit counseling session with our credit coach, her name is Krista Williams. You may have already spoken to her. She can be reached at the regular DebtWave line, 888-686-4040, and her extension is 143. Reach out. It's great. It's one-on-one evaluation of your credit, and then tips that are specifically tailored to you. Lastly, for me here, before we get to questions, and I do see we have some coming in, so I do appreciate that. Feel free to continue learning. We do have a podcast that we have. It's a weekly podcast on everything personal finances. We do have a credit episode on there where we have it on every personal finance topic we could think of. And there's a new weekly episode. So if you do podcasts, check it out. You can find it anywhere you find your favorite podcasts. And we'll get started with some questions. Thank you, everyone. All right.
All right, Phil. So I know that people could send a few different questions. They could go to you or me, and I have a few, but if you got a few that you want to answer, go right ahead.
We can go with, I think we get them at the same time, but if you have questions, I think Katie's got some from Facebook. And someone mentioned, what is the average credit score for someone paying off credit card debt? And this is one where you definitely want to join us in 2 weeks for our next swim live, because that is specifically what that one will be about. Someone can be paying down debt and have a great credit score, and they could just be in debt way more than you can imagine. And then someone may have no debt at all and a really poor credit score. So as far as, someone paying off debt and what their credit score is, it really depends on so many other factors, as far as how much debt compared to how much available credit they have, what their payment history is, because someone can have a lot of debt and always make their payments on time, and their credit score will be higher than someone who has a lot of debt but misses payments here and there. So it's definitely going to be a very case-by-case
Yeah, and it depends on their credit limit as well. Like if they have very high credit limits on their credit cards, but they're still carrying a lot of debt, that doesn't mean they're financially in good shape. It just means that ratio is up there.
Yeah. And then someone asked, will we be sending out a transcript? The audio is not working. I don't know if we're going to have a transcript, but I do know that this video will be available on Facebook at some point today after the presentation. So you always go back and check it out there. And then don't know specifically regarding the transcript. We'll have to get back to you on that one. But if you shoot us an email or if you get in contact with us, we can definitely try and figure out that audio problem.
So Felipe, I have a question here.
Yeah.
The question is, if I am trying to reestablish my credit and I have paid back my debts, what is the best way to reestablish the credit?
Okay. So credit is one of these tricky things, almost like a catch-22, where you have to use credit to build credit. So if you've paid down your debts and you're looking to reestablish, re-increase your credit, you do need to be using your credit. Now, I'm not saying go on a shopping spree by any means. I'm not saying, go fall back into debt. But you want to be using it, whether it's you're paying off a student loan, a car loan, a mortgage, or simply getting a credit card. If you have one already, using it every month for something you were going to buy anyways, whether it be your cell phone bill, groceries, gas, whatever it is, something you were going to, as long as you're not paying more to use it at the gas station, for example, something you were going to use anyways, and then pay it off every month. And you do that repeatedly over and over and over. It keeps your debt to credit ratio at or about 0 because you're paying it off every month. And it creates that payment history. And you do those two things over and over and over, 35% payment history, 30% your debt to credit ratio, and that's 65% of your FICO score. You do it over and over and over, that gives you good positive credit history, and you've taken care of 80% of your credit score by just doing those two things. And that's going to be really beneficial to trying to build your credit, whether it's starting over or starting anew.
So another question we have is, what if you want to buy a home? Is the first time home buyer a good route if you are still paying down debt?
Is buying a home while paying down debt a good, is that the question is?
Yeah, it says, what if you want to buy a home? Is the
Mhm.
first time home buyer a good route if you are still paying down debt? So basically, should I be going and adding, should I be looking at buying a home when I'm trying to pay down debt?
Yeah, and here's one where it's going to be very case by case. It really depends on your budget and what that allows and how much debt, because, you know, someone might be saying, you know, I'm paying down debt. It feels like a lot. I owe $1,000. But to someone else, that $1,000 debt may not be that big of an impact. So it really depends on so much on your budget, you know, the amount of debt compared, you know, your amount of debt compared to your available credit, and obviously with anytime it has to do with houses, the housing market, that has to come into play, and that's a very complex situation in itself. We're out here in San Diego. The housing market is very expensive, and getting worse. So, you know, there's so many more factors that come into play, and it's very case by case, because paying off debt can mean I'm almost done, but it could also mean I'm drowning in debt, in which case you want to hold off on the
And
home
typically your
purchase.
lender, when you're working with your mortgage lender, they're going to go through all of that very closely as well. So they're going to be able to see all of the debt that you have versus what you have as your assets and your income. So that will be really discussed in that situation. So it is a good idea to work with a lender, figure out where you stand, you know, somebody that really knows what they're doing, so they can really look at it and they can say, look, this is the amount that you could handle right now. Or, you know, if we pay this back down a little bit more, you might be in a little bit better shape in a year. So coming up with a game plan is a really good thing. And as somebody mentioned, if you want to buy a home, you need to establish more than one credit card. Yeah, that is very, very true. It's just the question was, you know, should I be doing it if I was still paying down debt? Another question, is it smart to add your child to one of your credit cards to help them build credit for the future?
So it's called piggybacking, and you can um, add your child to your credit card. Just be aware that um, they will receive good or bad credit. So if you have a credit card that has a high, you know, is 90% credit usage, and, you know, you're missing payments here and there, it could potentially be more of a detriment than a help to your child. Um, you know, and just because you put them on the account doesn't mean you actually, if you do decide to do it, doesn't mean you actually have to physically give them a card, so they don't have to go on a, you know, have the ability to go on a spending spree with your credit card. But it could help them get started, uh, so that when they do go apply for their credit, they have some kind of payment history. Now, this is assuming that it's like a older, you know, you don't want to put your 3-year-old on there because it's not really going to do much for
Yeah,
them
that
at
doesn't do
that point.
much.
Yeah. It's
Yeah,
assuming that it's a 18, 19-year-old child that you're putting on there.
yeah. Authorized user.
Yeah. So I do have another question here from Katie in Facebook. Um, Someone asked, how much will my credit score change on a weekly basis? And what is the benefit of checking every week? So your credit score can change all the time. It's very dynamic. Now, it shouldn't be giant leaps and bounds in any direction. Otherwise, that's definitely going to be a red flag. You know, if your credit score takes a nosedive, definitely want to look into it and make sure that you know, pinpoint why that is that happened. But small fluctuations within your credit, it's going to happen, you know, especially if you're out there using credit cards, you're making payments, and a few points either way, it's not going to be something where, you know, ooh, my credit score changed 3 points. I have to go determine what caused that. Now, if you're looking at like a 25-point drop or things of that nature, you definitely want to look into it and make sure that you pinpoint why that is that happened. This is assuming you're comparing the same credit scores. And then someone asked, what is the benefit of checking, same question, benefit of checking every week? The benefit of
That could
staying
get
on
very
top of your
expensive.
credit, it could, you know, it's just having that constant awareness and that constant looking at your credit report is going to help you spot possible fraud or errors a lot faster. And I think that's why it was put in place that you can check it more often right now, because so many people are, there's so many people across America struggling. And unfortunately, sometimes that's when the scammers and the fraud artists are out taking advantage of people at their most vulnerable point. So it's just an extra tool that you have to check your credit constantly. And I have another one on Facebook. Katie, thank you for relaying those to us. I don't have a student loans or a mortgage, and I don't need a new car. Is not having an installment loan really hurting my credit?
No.
And no. And remember, that was only 10% of your total FICO score. So if you don't have an installment loan, it's not going to be a huge detriment to your credit. Eventually, you want to get some in there. And remember, things stay on your credit report for 7 years. So if you had a car payment you paid off 2 years ago, that installment history in that payment, that loan, is still on your credit. You don't have to actually be paying it right this second. So no, it's not something where, oh, you don't have an installment loan, go out and buy a car, even though your budget says don't do it, or you don't really need one. That's not what we're talking about. But it may have a small impact, but it's not going to be a huge detrimental thing where you have to go run out and get one.
Phil, I got another one here.
Yeah.
It asked, how come when I look at how come there are 3 different credit scores when I look at them?
Okay, so that's a good question. And the reason that you could be looking at the same like FICO 8, and you could have 3 different scores. And the reason for that is all of us as consumers have 3 credit reports, one for each of the 3 credit bureaus, the Experian, Equifax, and TransUnion. And in a perfect world, your credit scores will all line up exactly the same, but we don't live in a perfect world, as we've all figured out. So there may be slight variations on your credit reports. You may have one lender, especially with smaller lenders, that may only be reporting to 1 or 2 of your credit bureaus and not reporting to the other. So now what that creates is different information that's being put through the FICO algorithm, so it pops out different credit scores. And that's where the variation is going to be, And if you're checking all 3 of the credit reports and you check them side by side, you can usually tell, like, oh wow, look, my furniture store credit card is only on this one, not on the other 2. And good or bad, that creates a difference in your credit profile.
It says here's another question. It says, are there specific credit cards you recommend in trying to build your credit score?
So, and this is going to be, we get this question all the time. What's the best credit card? It's different. It's very individual to each individual situation. Things to take a look at and consider is going to be, fees, APR, which stands for annual percentage rate. At any point in time, if you're going to go get a new credit card, you want to make sure that you can get the best one that your credit profile will allow you to get. So something with low APR, something that has low fees. Normally you want to stay away from store cards or gas cards or things of that nature, because even with great credit, your APR is going to be higher under those credit products. Definitely take a look at your credit unions if you have any around. They tend to offer sometimes lower rates, but do your research beforehand online and try and figure out, for your credit profile, whatever that happens to be, what is the best card I can qualify for? And in each individual situation will be different.
Phil, I have, if you could go back one screen and put Crystal's number up there again.
Yes.
There are a few people that are looking for her number.
Yes, 888.
So we want to give that out.
888-686-4000, extension 143.
Thank you. And I think we have time for like one more, 2. We'll try to get in 2 more questions. This question says, when you use your credit card and want to pay it off every month, is there a length of time to wait? if I purchase something today, can I pay it off next week? Oh, I understand what you're saying.
So, so you're saying like, or do I have to wait until, like,
I
can
think what she's
buy
saying is,
something?
is there any benefit for me to pay this off as soon as I like make the purchase, right? So do I get brownie points for paying it off within a week? And the answer to that is no. You want to just pay it off within that billing cycle, because none of us are paying interest on new purchases until that first billing cycle comes through. And so there is no hurry in paying it off. As long as you pay it off within that billing cycle, when that payment is due and it's off, then you're not paying interest on those purchases.
Yeah, so you get your statement and it has the statement balance. If you send in that or more, then before the due date, you'll be okay. But you're more than welcome. You know, some people just don't like to see the balance sitting there, and you want to schedule, or maybe you get paid, every other week or every week, and you want to pay off some of it that way. Whatever works for you. Just make sure that you at least pay off the last statement balance before the next due date, and that'll keep you from accruing any kind of finance charges.
And I think this will be the last question we have. It says, where can I check my credit score?
Your credit score. So your credit report, you can check on annualcreditreport.com. And there that's the website. You can pull all 3 of your credit reports for free. That doesn't give you your credit score for free, just the report. As far as where you can get your credit score for free, if you're with DebtWave, give your counselor a call, give Crystal a call, and that's definitely something they can help you out with.
Experian.
What was that?
Experian credit score.
Yeah, your Experian credit report. You can't get all, we don't have all 3 of them. But you can also, if you have a credit card, they may offer it free monthly, depending on which one of the lenders you have. Most of the ones I've seen now are starting to offer some kind of credit tracking, where you may have to opt into it, but you can get it for free there. And you can always go back, and it updates weekly, monthly, depending on which bank it is. There's
myfico.com, you can pay for it.
myfico.com, you can pay for it. But then it just adds another expense to your monthly budget. There are other places that may provide you your score. You just want to be careful that which score are they providing you for free? Is it a Vantage score? Is it a FICO score? And then weighing that with any possible future decision making. So if you're getting a Vantage score and you're thinking, I'm going to go buy a car, just be cognizant to the fact that that may not be the same credit score that the auto lender is going to use to determine whether or not to give you new credit or how much credit you can get. So just being aware of that, I think is going to be key. Knowing which score you are getting, if you are getting a free score from somewhere.
Yeah, and we've had a few people mention that, like Chase Bank, Capital One, and most of the banks do that now as an added benefit to you banking with them. So that's always a good way to go, as well as looking in to see if the place you bank with has that opportunity as well.
A lot of them have it. Citi, Discover, a lot of the credit unions now offer it.
Well, Phil, I think, we'd like to thank everybody for joining us today. That is our allotted time. I do want to let everybody again know, if you want to go one-on-one, please contact Crystal. She's available and she can talk with you specifically about your situation. Also, make sure that you join us next time for our Smart With Your Money Live on Wednesday, September 23rd, our next episode at 1 p.m. Eastern and 10 a.m. Pacific.
Perfect.
Phil, thank you very much for the information today.
Absolutely. Thanks for having me. It was fun. And thank everybody for taking time out of their day to show up and
Somebody
listen.
asked, what is the fee to consult with Crystal? $0.
Correct.
That will cost you nothing.
All right.
Thank you, everybody. We'll see you that Wednesday on the 23rd.